Hey, what's up, guys? It's Larry, the mortgage guy, your mortgage insider, and certified veteran mortgage advisor. And today we're going to be covering uh, honest answers to top 10 home buying questions. Now, this is a um, class I've done in the past many times, but I like to cycle through my classes because depending on who's watching, who subscribes, you might not have seen this class before. So, if you have been following me, you might be familiar with some of these, but that's okay because I always want to improve and answer the questions better. So maybe you have a question that I haven't heard and I can answer it for you. Okay. So I'm going to go ahead and share this real quick into my chat so that everyone can join, whoever's watching. Right now, I have 4 people live. Cole, thank you for joining. If you do want to join the Zoom and be able to answer questions directly, you can always click the link that I just sent in the chat if you're watching this from Facebook or YouTube or LinkedIn, and you could join directly and actually answer the questions or ask the questions uh, as part of the Zoom. Okay. So, all right, let's go ahead and get started. You already got people joining, so I'm going to move on. All right. So, as you guys can tell, I actually rebranded myself because I switched companies. But I am a certified veteran mortgage advisor. I'm part of the Larry Lee team at Open Mortgage. I've been licensed since 2016. I have a side hustle as a social media marketing coach and running my own ad agency, Robots LLC. Now, the reason I bring that up is because I want to sort of use my abilities and my resources as a social media marketer to promote the home buying classes that I teach because I want everyone on the planet to be as savvy as a home buyer as I think they can be. And this is my goal is to coach people. I don't care if you're using me or if you're using someone else. I don't care if you're a cash buyer or you're looking for a mortgage. It doesn't matter to me. I want to give you as much information as possible about the home buying process so that it demystifies and takes the fear out of the home buying process. Because I think there's a lot of confusion, and my goal is to sort of take that confusion away. I am licensed in 10 different states: Arizona, California, Florida, Illinois, Indiana, Louisiana, Michigan, North Carolina, Tennessee, and Texas. But my branch that I work with is licensed in 30 states. So there's a chance that we can still help you, even if I'm not particularly licensed there. We have multiple loan officers there. Okay. My NMLS is 1440741. Right. My mission is I love the mortgage business, but I was fed up with the lack of education and information clients were provided during their application process. So I created a first-time homebuyer coaching class that provides instant access to answers to questions and simple explanations to the mortgage process and how to qualify for mortgage clients, as well as being available for one-on-one coaching. What that means is that I want to create like an on-demand library of content, kind of like Netflix, I guess, but for mortgage content, right? And that way you can find out what it takes to buy a house without having to talk to a loan officer because we're salespeople and you guys might be fearful or hesitant to engage with us. Well, I want to give you the information without having to engage with one of us. But if you do want one-on-one coaching, I'm here to provide that. But of course, you can't hide from me. You can't ghost me. It would be hard for me to tell you what to do for your particular situation without actually getting your information. Okay. But either way, you can get information whatever method you want. Unlike other loan officers, I mean my passion to coach first-time homebuyers on the mortgage process, and that makes all the difference in how I have helped hundreds of people get on the right path to home ownership, and many of them are now homeowners. You remind me of many of my smart, successful, and savvy clients who are now homeowners because you are taking the right step to the home purchasing process like they did by being on this call, right? You're looking for information, education, right? The home buying process is very confusing to most people, but that's why I am here to simplify and make sure you're 100% prepared in the home buying process before anybody else. My wife, of course, is my wife and my kids, particularly Hunter and Bruce. They are on the spectrum for autism. They are nonverbal, and I believe that they could use a little bit of help in growing and developing. And I want to provide that through ABA therapy, which is very expensive. So my goal is to have enough resources this year to provide them that therapy. My other why is, of course, serving home buyers, especially veterans. That is why I'm a certified veteran mortgage advisor. My why is explaining this post I made on Facebook. My father was living in Da Nang, Vietnam during the fall of Saigon. My mother was living in Saigon. My father left by helicopter, my mother by boat. It was US soldiers who helped them get in the helicopter and on that boat. They met in Hong Kong, China. If it wasn't for a US soldier, my parents may not have survived, met, and had me, and I wouldn't have what I have today. I might not even exist. Those US soldiers are veterans now. Thank you, vets. I owe you my life. And what I mean by that is literally, if it wasn't for veterans or it wasn't for US soldiers, my parents may not have been able to escape Vietnam and survive. and they never would have met, and I wouldn't have been born, and therefore my children wouldn't have been born. So I basically owe them everything. Okay, which is why I feel like I owe dedicated gratitude, and why I focus on helping veterans whenever I can. So I actually have a webinar where I go over honest answers to top 10 home buying questions. I go over questions loan officers should ask before taking an actual 1093, meaning before they actually should pull your credit, right? And I have top 5 things not to do when buying a home, and it's not what you think. I can't cover all that today. That's a webinar like this would take like 2+ hours. I want to cover a part of this. So I want to cover the honest answers to top 10 home buying questions today. The next call, which won't be this week, this coming week, but the next week after that, I'll cover the questions loan officers should ask before taking an application and pulling your credit. And then 2 weeks after that, I'll do the top 5 things not to do when buying a home. The reason I'm doing it like every 2 weeks is because I have my veteran class or VA loan class that I do, and I've decided to kind of marry the 2 classes. I used to do one on Wednesday, one on Thursday, but because of summer, I can't do that. So I decided to put them in the same time slot. So I'm taking turns, like going back and forth. I'm going to do the first time home buyer class, and then do the veteran VA loan class, and then I'll do the first time home buyer class, and then do the VA loan class. So if you can subscribe, you'll be subscribed to both of them, and you can choose which one you want to go to. But it'll always be the same time slot. Okay. But I will cover all these. But for now, I'm going to cover the honest answers to top 10 home buying questions. Okay. Disclaimer: I'm not trying to piss anyone off or make anyone feel stupid. I am simply trying to provide transparency because most loan officers are doing a horrible job of telling you the truth. And when I say telling the truth, I'm not saying they're lying to you. They're just not giving you all the information you need. Okay, they're just too lazy, or they don't think you need to know, or they're actually trying to hide it, right? But there's a lot of information that they can share with you that can make things better for you in terms of the home buying process, and they're not sharing it with you. I'm going to pull back the curtain and share everything with you. Okay. Also, any information I share is general knowledge I acquired through training and experience. Every situation is subject to a case-by-case basis, and exceptions are always possible, especially with different lenders and financial institutions and states. So what I say might not be true in California, right? I'm in Texas, right? But I'm also licensed in California too, by the way. But either way, what I say is not law, okay? And again, it might be subject to change. It depends on when you're watching this. I mean, I'm doing this call on June 15th, 2022. If someone watches on June 15th, 2023, the laws might be totally different, right? Who knows, right? All right, so the top 10 questions being answered honestly by a lender. I call it Real Talk, right? It's part of my home buyer secret coaching class. And these are the questions I address, okay? Number 1, what do I need to qualify, right? Number 2, do I really need to be pre-approved? Number 3, what's the first step of getting pre-approved? 4, who do I need to talk to first, a loan officer or a real estate agent? Number 5, how do I know how much I can afford? 6, how much money do I need in order to buy a house? Number 7, what loan programs are available? Number 8, how do I get 0% down? Number 9, what is the interest rate? And number 10, how do I get the best interest rate? And I have a bonus question as well. Now, if you're watching this as a replay, you'll probably see links on the top over here. I actually get deep on each individual question as well. So this one is like my general top 10 where I kind of gloss over the 10 questions, but I actually have classes and Zoom calls and YouTube videos where I actually break down each individual question and I get really deep. I call it a deep dive, right? So again, if you're watching this through a YouTube replay, you could probably find a link somewhere and you can see me get really deep. Like I'm talking about like an hour long of just talking about question number 1, right? So yeah, just be on the lookout for that. Okay, so question number 1, what do I need to qualify? Really, there's 3 major pillars in terms of qualifying: income, assets, and credit. Okay. Income, the best way to make it easy is to know that you need 2 years of consistent income, whatever it is, whether you're self-employed, whether you're a W-2 salary hourly worker, whether you're on commission, whether you're on contract. 2 years is really the rule of thumb, right? If you have more than 2 years in anything, then you probably are pretty good, depending on how much you're making, of course. But if you just started like last week, and it's a totally new, like let's say you started your own company last week, you might run into some issues. But of course, that's the case by case basis part, right? But I put that you need to at least have a job. You can be self-employed or a business owner. It can be retirement or social security income, child support, and alimony accounts. Asset depletion, which is kind of an interesting thing. Let's say you just have a huge chunk of money, maybe you inherited a bunch of money, or maybe you've been saving a lot. You can actually use your assets as income, depending on how much you have and how much you can afford in terms of monthly withdrawals, right? And then there's also other additional incomes, part-time income. Maybe you're getting royalties of some sort. I've been working with a lot of clients with oil and gas royalties. Again, that gets really specific, but those 5 that I listed are not the only ways to make money, right? In terms that we can qualify you for. Okay. Assets, sourceable, meaning that's kind of the rule of thumb, is like we have to be able to trace it. We have to be able to find a paper trail for it, right? So cash under the mattress doesn't work. So they say cash is king. Not in this particular case. Cash is not king. So gift funds, that's money or funds provided by a donor, someone more than likely related to you or close to you. 401ks, money that was preserved or saved aside in kind of a savings from your work. Funds in this in savings and bank account, which is of course should be obvious. And I put cash is no good. Cash is not king, meaning you can't just all of a sudden deposit your 20% down into your bank account and expect that to work. Rule of thumb is we just can't see the deposit, right? So if let's say you plan to buy a house in December, make the deposit in August, September, right? Because we're going to ask for December and November bank statements, and we don't see a deposit. We're going to make the assumption that's always been there. It's going to be seasoned, is what they call it, right? I know it sounds kind of funny, but that's just the rule, right? Like they're not allowing you to use cash, but if we don't see the deposit in the last 60 days, then it's what it is, right? So that's their requirement. Okay. So it has to be sourceable. Credit. This is probably one of the more complex qualifying pillars. It must be a hard inquiry with a lender. So the reason I bring that up is because a lot of people think that they know their credit scores because they have Credit Karma or they have their bank telling them. The thing is, if it's not an inquiry, a hard inquiry, that's not the correct score. What I mean with that, and that's why I think the confusion shouldn't be there, but people still get confused. If you didn't get a lender to pull your credit, that's not an inquiry. So everything else is a non-inquiry. A consumer credit report, a consumer paid credit report, you can look at it as a soft pull. I don't look at hard and soft pull. To me, it's an inquiry or non-inquiry, right? There's no soft pull, right? They call it a soft pull, but I really think it's just it's incomplete information is the way I look at it. So it's either complete information or incomplete information. So a soft pull shouldn't be called a soft pull. A soft pull could be, let me give you an incomplete credit pull versus a full credit pull, right? Well, I'm saying we need a full credit pull, which requires an inquiry, right? And how do we know that you're getting a hard inquiry? Well, you're talking to a lender who's pulling credit through their credit reporting system using FICO 4, 5, and 2, right? Again, let me repeat that. For FICO 4, 5, and 2. You can Google it. You can look it up. I have videos about it. If you look up the video, Credit Karma sucks. I made a video about that. It explains to you what that means. Okay. So there's a difference between what you see and what lenders are going to see, because the lenders are going to get a hard inquiry and you're not. Okay. They call it consumer paid credit report or consumer paid credit pull. Consumer, meaning you, not the lender. Not going to be the same. Okay. You might get close depending on certain sources, and I actually give you advice on how to do that. But let's just keep it simple. What you're looking at is going to be different from what I'm going to see. So what I'm going to see is what counts. Okay. And why does that matter? Well, Fannie and Freddie, who are the people who sort of regulate the mortgage industry, not on the government level, but they regulate like the guidelines. They require us to use the same credit reporting system, meaning all lenders who plan to use Fannie and Freddie as the secondary market where they actually sell the mortgages off to, they require us to have a credit pull from FICO 4, 5, and 2. That's why we all use it. Okay. So that's why it's the standard. So I don't care how cool or how great or how happy or how valuable you think the credit scores are that are out there. If it's not FICO 4, 5, and 2, it's not being used. Okay. And why do I harp on this? Because a lot of people are misinformed, and I'm harping on this a lot because if anything you get from this class, what you see online, Credit Karma stuff, is a Vantage score, and we need a FICO 4, 5, and 2. So you're just being misinformed, right? So you're walking around thinking you're a 700 credit score when in fact you're more like a 620, right? So just be prepared for that, okay? But in terms of qualifying, 580 for FHA. If you want a 3.5% down, you can get a 500. You can get a mortgage with 500 credit score with 10% down, but it's very rare. Meaning, not very many lenders do that. Okay, but that is a possibility, right? You can get away with a 500 credit score if you put 10% down. Most places are looking for 620, at least, for conventional, but you're probably not going to go conventional if you're at a 620. You're probably going to end up being just a strong FHA or stronger FHA. Most lenders and banks are looking for a 640 at the least, right? For anything, right? Conventional or not. So I put best to check with your local lender because everyone has different standards, different expectations. When I say that, is they call them overlays, right? An overlay is an artificial or created restriction made by the policies of the company, not the actual mortgage industry. So what I mean by that is you qualify a 580 credit score, but because this bank doesn't allow anyone below 640, they're going to deny you. And they might even act like you can't get approved anywhere. They might not know any better, or they might be lying to you. Who knows, right? But the truth is, you might get denied for 640 at one lender, but you can get approved for 580 with another lender. I know this for a fact because I had clients who I qualified at 583 credit score, and they were turned down by 3 other lenders saying that they will never buy a house, when in fact that's not true. They just talked to the wrong lender, right? So if you want to find out, just ask them, is it an overlay? If they deny you, is that an overlay or is that like an actual Fannie Freddie restriction? And if they're a good loan officer, they should be able to give you the answer, right? Or you can get a second opinion from someone else. I'm volunteering just in case you need someone, right? Number 2, do I need to be pre-approved? The answer is yes. Okay. It's kind of a silly question, especially in this market. I've actually had clients in the past who said they didn't want to do anything. They didn't want to get the credit pulled. They didn't want to do any paper, whatever, until they find the house. And that's kind of ass backwards. The reason why I say that is because, at least in this market, people are not entertaining. When I say people, I'm talking about listing agents and sellers are not entertaining any offers unless you are verified in terms of your ability to buy and your ability to provide funds, et cetera, et cetera, et cetera. So they're going to want you to be, it's like getting a background check, right? They're not going to give you the job unless you have a background check and you cleared it. Okay. So the question really should be, do I need a background check? The answer is yes. Without a background check, no one's going to take you seriously. No one's going to want to hire you, right? No one's going to give you the job, right? In this case, no one's going to give you an offer. Now, there's exceptions, of course. I've heard of people getting contracts and they're not even approved yet. I don't know where these people are from, but that's not the norm. Okay. So the answer is yes. Most listing agent sellers will require a person to be fully pre-approved in order to entertain any sort of offer, especially in the hot market. What is pre-approval? Pre-qualification, from my perspective, is if someone fills out an application, they put their name, number, email, they put their income, they put how much they have in the bank, and we pull their credit. It looks good, and we're like, okay, cool. Everything looks good. Your credit's good. The information you provide me shows that you can afford to buy a certain amount. So yeah, you're pre-qualified. Here's a letter. That's a pre-qualification, right? You're using a credit pool and stated information. A pre-approval is like, okay, I need to look at your W-2s. I need to look at your pay stubs. I need to look at your tax returns. I need to look at your bank accounts. Okay, it does look like you have this much in the bank. It looks like you do make this much income based on your pay stubs. So I'm gonna go ahead and give you a pre-approval. This is a verified qualification. I've looked at your documents and I believe what you're saying is accurate in terms of how much you make and how much you have in the bank. Now, certain things might require a little bit more work. Say you do overtime, right? You're trying to qualify based on overtime. Well, overtime needs to be verified by the employer, right? So that's what we call a VOE, or verification of employment, or written verification of employment. We need your authorization to reach out to your employer, and then we actually reach out to the employer and ask, is this person going to continue to get overtime for the foreseeable future? They have to say yes. So if they say yes, okay, we can help you. If they say no, then obviously we can't use your overtime. So depending on how much you're trying to qualify for and how much of your income is being used, we might need to go beyond just looking at your documentation. Okay, but that's really what a pre-approval is, right? And I put, they review your credit, hard inquiry. Again, it has to be an actual inquiry, not a Vantage score from Credit Karma. Okay, we look at your W-2s, pay stubs, 1099s, tax returns, VOE, assets, usually a bank statement, savings, or 401k. And we submit it all through the automated underwriting system. You can actually submit the automated underwriting system using a stated information. Whatever you put in the 1003, it's going to use that information anyways. But of course, in that situation, you actually can put anything. I can put, you may have $1 million in the bank, right? So it's only as good as what you put in terms of a pre-qualification, a pre-approval. You actually have like the documentation is verified, and you know you're putting in actual facts into the system. So when you get an automated underwriting system approval eligible findings with verified documents, then you know you have a strong pre-approval, right? And some listing agents have asked for that. I don't think that's legal, but they have asked for the findings from the AUS, right? But yeah, that's what the pre-approval is. Okay. What is the first step in getting pre-approved? You got to speak to a loan officer, right? You got to explore the current situation and goals. Like you can't get pre-approved without a loan officer. Let's just put it that way, right? It's almost like trying to get into a house without a realtor. It's not going to happen, right? Realtor has to be able to let you in, right? Loan officer has to be able to look at your credit and decide, can I give you a pre-approval letter, right? And again, I'm using pre-approval and not pre-qualification, right? I've heard of loan officers who actually will pre-qualify just by talking to someone. Now, what do you think your credit score is? 800? Okay, I believe you. How much money do you make? Okay, cool. I believe you. How much do you have to make? Okay, I believe you. Yeah, you sound good. I'm gonna go ahead and pre-qualify you. Yeah, I've heard of lenders doing that. That's why you need a pre-approval, right? Pre-approval is like you're basically saying I've reviewed your documents, or whoever's reading the pre-approval letter, it should say documents have been reviewed, income has been reviewed, bank statements have been reviewed, yada yada yada, right? That way, the listing agent knows that this person is vetted out. There's an actual background check, right? So again, you got to speak to a loan officer if you want to get pre-approved, right? And you got to fill out an application and get your credit pulled. Okay, so there's no way of avoiding that. So yeah, easy. For who do I need to talk to first? Loan officer and agent. A lot of real estate agents might not like this, but I think you need to talk to the loan officer first. Why? Because a real estate agent doesn't know what you can do until you get pre-approved, right? I mean, you can, as a client, you can tell them whatever you want, but they really don't know. Like a real estate agent won't know what your buying power is, what your price range is, right? I mean, the worst thing that can happen to them is they show you like 10 houses and you don't qualify for it, right? That would be a major waste of time and energy, and a lack of clarity will create a little bit of conflict and discord in the home shopping, home guidance process, right? So the realtor is going to want to know what they're working with and therefore make a more intelligent search, right? Because there's lots of houses out there they can show you. They need to know which ones, right? So loan officer determines whether or not you're pre-approved, provides your maximum buying power, and provides pre-approved letter to make offers, right? Now there's exceptions, of course. The exception is if you if you have a real estate agent that you trust, you know them, you trust them, you're related to them, whatever, you worked with them in the past, friends highly recommended them, then yeah, talk to the realtor first, but they're still not going to be able to show you houses until you talk to a loan officer. So a loan officer, no matter what needs to be talked to, but it is good practice to talk to someone you'd like, know, and trust as a realtor and have them lead you to a loan officer, because that way you know it's someone they trust and they would endorse and they vouch for. So that's a good way to find the right loan officer, is talking to a realtor that you like, know, and trust. Okay. And you know that would do a good job. So that's the exception. But I put that good real estate agents normally won't show houses to people who are not pre-approved. They need to know how much you can afford to properly assist you on your home search. And they know that most listing agents and sellers won't accept offers without pre-approved letter, which we've kind of talked about already ad nauseum, right? How do I know how much I can afford? Again, well, you got to talk to the real estate agent. Okay. I mean, you got to talk to the loan officer. You got to talk to the loan officer, right? You won't know unless we actually pre-approve you. Okay. But I'm going to break down how we figure that out. Okay. So that, if you want to try to do the math on your own, you can try, right? And I actually give you a little formula later. Debt to income ratio is the number one thing that you need to figure out, right? It's there's back end ratio and there's a front end ratio. Back end ratio is everything in terms of your debts, car payments, credit card notes, student loans, whatever, and the new house mortgage payment, right? Front end ratio is just the house alone, right? So when you see me give you these numbers, you'll see the front and the back. The front is going to be how much the percentage can be of your income could be for the house payment, and the back is going to be the percentage of how much can be total of all your debts. So max DTI for conforming loans, Fannie and Freddie, which is like conventional loans, the historical max is 28% to 36%. So if you're at like 35%, 40% on the front end, you're probably not going to qualify, right? there might be some exceptions. I put that they allow up to 43% DTI, and you can go up to 45 to 50% with compensating factors. What's a compensating factor? For example, let's say you've been paying rent for the last 10 years at $2,000 a month, and you're buying $1,000 mortgage. Well, you've proven for 10 years you can pay $2,000 with no problem. So there's no payment shock. It's the opposite of payment shock. Payment shock would be if you were paying $1,000 rent for 20 years and you went and bought a $2,000 mortgage house. Well, then there's payment shock. You're paying an extra $1,000. Can you handle that? Right. So that's a compensating factor. Okay. Max debt to income ratios for FHA. General guidelines 31% and 43%. As you can see, FHA is a little bit more forgivable. They want to help people. They know people might need more house and they might not make as much money. So they're a little bit more generous, more flexible with their DTI, right? It's based on findings from the automated underwriting system, and you can go potentially as high as 50%, 55% or higher, right? Meaning they give you more buying power. Conventional is like saying, we're not going to really want you to go above 45%, 50% maybe. FH is like, yeah, you can go 55%. We might be able to help you with that. We can see you doing a good job making your mortgage payments even at a 55% DTI or debt to income ratio. So again, they're a little bit more liberal, I guess, with their qualifying amounts, right? So you can try both, but most people who are looking to buy a lot of house with either lower scores or not as much income, FHA might be a good option. Okay, max debt to income ratio for VA loans, VA states 41%, but you can go potentially as high as 41 to 50%. Of course, with compensating factors. Now, I'm going to tell you something. I actually approved and closed a loan for a client a couple of months ago, VA, who had a 70% or 70+% debt to income ratio. How is that possible? Well, I mean, there's a lot to talk about that, but let's just put it this way. The VA has a different way of looking at things versus the rest of the other loan products, but they had a lot of residual income. Residual income is the best way to describe it is how much money you have left over after you pay all your debts, right? So the VA uses residual income as a qualifying factor versus like other loan products don't use residual income. But basically, residual income is how much do you have after you pay all your bills, right? And they had high residual income. Like they had a lot left over after everything's all said and done. So therefore, they qualified, even though their DTI or debt to income ratio was in 70+%. I actually took a screenshot of the findings. I'll find it later and maybe put in as a clip in the YouTube version of this, right? So yeah, again, there's exceptions, right? Max DTI for USDA loans. Now, if you don't know what a USDA loan is, it's loans for rural areas that are not highly populated, and they're encouraging people to own homes in those areas, so they allow for 0% down. Okay, general guideline for them is 29 to 41%. It's based on findings on automated underwrite, and you can potentially go as high as 32 to 44%. They also have, just so you know, income limits. That means you can't make a certain amount because they really want to help people who need help, right? From their perspective, if you make too much money, you should have money to put down, right? They're not going to give free money away to rich people, so to speak, right? So they want to make sure that the people that need help with 0% down are the people who just simply struggle to have a savings. So that's why they will have the 0% down. Now, of course, they want a strong buyer, so they're not going to give someone who's actually struggling to pay their bills, just struggling to save enough to get that. I don't know, 400,000. Well, actually, that might be too much. Maybe 200,000 house. Who knows? USDA has also a limit of how much house you're allowed to buy. Okay, like there's a limit of how much it wants to loan on, right? So yeah, again, all loan products have different DTI restrictions. So it's just best to talk to a loan officer about it, right? But if you want to try to avoid talking to the loan officer as much as possible, I give you this formula so that you can try to figure out on your own. Right. So basically what you do is you look at the recurring monthly debt. When I say recurring, I'm talking about your credit cards, car notes, things that would be considered a debt that you owe someone. You divide it by your gross monthly income, how much you make a month. And that gives you your debt to income ratio, or DTI. And this is going to be the back end. This is going to be like the total, right? So you have to add your mortgage to that, right? So that's how you know. And I actually put here on number 5 Well, this is the number 5, but I put monthly payments including DTI and monthly payments that are not including DTI, right? So that you know what you add into the total. What's included is mortgage payments, property taxes if escrowed, mortgage, homeowners insurance if escrowed, car payments, student loan payments, minimum credit card payments, finance purchases like furniture, like from cons, personal loan payments, child support payments, alimony payments, any co-signed loan payments, and government debts like the IRS, right? Now, payments that you don't have to add is going to be utilities like water, garbage, electricity, gas bills, car insurance, cable bills, cell phone bills, health insurance costs, groceries / food or entertainment expenses. Now, the best way to figure out what goes where, if you can cancel it, then it's not a debt, right? Like I can cancel my insurance, my car insurance, not home insurance, but car insurance anytime I want. I can cancel my cell phone bill anytime I want. I can turn off the water anytime I want. That's not a debt. That's a service I'm paying for. I'm renting that service, whatever, right? But like alimony, got to pay that. Student loans, got to pay that. Car payments, got to pay that, right? So that's the way you kind of figure it out, right? Of course, you can always reach out to me or another loan officer to figure that out if you're trying to do this math without having us to actually help you, right? But yeah, just wanted to let you know that's how you figure out your debt to ratio to put into this formula. Okay. Again, recurring monthly debt divided by gross monthly income. That's your debt to ratio. And you got to be careful, right? You might forget to add something. You might add too much. Maybe the mortgage. I mean, how are you going to figure out the mortgage payments? Who knows, right? Maybe you use this to figure out what your comfort zone is in terms of how much you can afford, right? And that way, you know what kind of house you might want to buy. So even though you might be able to afford a $300,000 house, you might be more comfortable with a $200,000 house based on the mortgage payments, right? So this is useful if you want to try and employ it. Okay. I am pausing to see if there's any questions. Let's see here. Anyone, if you're on Zoom, you can always unmute yourself, or you can put in the chat if you have a question. Or if you are, if you are watching this on like the live stream, meaning like on StreamYard, like you're on Facebook or LinkedIn or YouTube, then you can always ask the question in the comments, right? Doesn't look like there's any questions, so I'm going to go ahead and move on back to the slides here. All right. So how much money do I need in order to buy a house? Number 6, right? It really depends, of course, on where your situation is and what loan product you want, but I'm going to give you the typical down payments, right? You can actually go 3% on a conventional, on a home ready or a home possible loan. Home ready, home possible is a special product for conventional. It's income based, meaning you can't make too much income, and it depends on the zip code that you're moving to, right? So you can get 3% for conventional, which is a good option if you're looking to get a conventional loan, but you don't want to put 5% down. Okay. Again, you got to talk to the lender about that. 3.5% is typical for FHA, unless you're at the 500 credit score or above, and you're trying to get 10% down. But again, not very many lenders provide that, so I don't really talk about it. I think I've done it once or twice in my career, but with a company I'm no longer with. So I don't know if my company right now does that. Okay. Maybe it's possible. I don't know. 5% for a normal conventional. When I say normal, I'm talking about like the typical one, right? The one that everyone uses, right? Is 5% down, but you can put 20% down if you want to avoid mortgage insurance, which a lot of people want to avoid. I have my own opinions about that. I think it's actually kind of silly to make a decision based on just mortgage insurance. But again, I have my own opinions. But that's what a lot of people try to do to avoid mortgage insurance, is having 20% down, and it's 0% down for VA and USDA. Okay. Of course, there's still closing costs and such on all of these loan products. So don't just think that you only need the percentage I'm telling you here and you're good. Like I've actually had people tell me they have 3.5%. They're good. I'm like, no, you're not. You are probably not even halfway there, right? So be prepared to have more than just what the percentage. And a lot of people, they make the mistake. They think down payment is like a fee. You're not paying a fee. When you're putting down payment, you're actually buying equity, right? So it's yours, right? So if I put 20% down to my house, that's not me paying a 20% fee on the house. That's me putting 20% towards my house. It's like a deposit on my house. That's mine, right? It's still mine. I'm just transferring the funds, right? from my pocket or from my bank account into my house, right? So you can't look at the 3.5% down as being too high or 20% down being too high. That's you're really just paying yourself, right? It's separate from like the closing costs and appraisals and things of that nature. Okay, so just use that kind of mentality to be prepared. Okay, in terms of when it comes to funds, closing costs without taxes. Okay, so when I say without taxes, I'm not talking about adding taxes to part of your closing costs or your cash to close, because it depends on what house you have. You can get $100,000 house and $1 million house, and the taxes are going to be different. So that's why I didn't put that in there, because it's way too confusing, and there's way too many possible answers to that. So let's talk about closing costs without considering taxes. It's going to be anywhere between $2,000 to $4,000. Okay, you got lender fees like the loan application fee, prepaid interest, points to reduce the interest rate, meaning you want to get a lower interest rate. Some people are required to do that in this market because of how crazy the rates are. Like, you're required to buy down the rate in order to qualify. Okay, origination fee or loan fee, which my company doesn't charge, but a lot of lenders do. Broker fee, underwriting fee, processing fee, mortgage insurance, rate lock or rate lock extension fee, right? The rate lock itself actually might not cost anything, but the extension might, right? Closing costs without taxes continue. Third-party fees like title search, lender's title insurance, borrow title insurance, appraisal fee, attorney fee, state specific. Texas is a attorney fee, so we use that. Okay. Pest inspection fee, that's usually for the VA loan. Flood hazard determination fee, that probably would be somewhere in Houston, right? Any kind of place that floods a lot. Credit report fee, settlement of escrow agent fee, deed recording fee, property transfer tax, courier fee, wire transfer fee, condo certification fee, homeowners association certification fee, loan documents preparation fee, notary fees, VA funding fee. Again, that depends on what's going on with the VA loan. You might be able to get that waived if you are a certain percentage disabled. FHA upfront mortgage insurance premium, USDA guarantee fee. And I don't know all these fees, right? Like, if you ask me what's a courier fee, I might not be able to give you a good answer. Right? I just know it's part of it. Okay. But of course, you can always reach out, and I can always do the research if I don't know the answer, but I might. So again, you ask your lender, right? This is part of the same question. Prepaids. Prepaids is something that a lot of people don't think about, right? And sometimes when I explain it to them, they're like kind of appalled by it, or they're like shocked by it. I'm like, well, you kind of have to understand that this is how it is to buy a house, right? They want to put you in the best position possible, but they also want to protect their interests. What I mean by that is, if you really think about it, a mortgage is someone else buying the house and letting you live in it and basically you're paying them back before you get the transfer of title, before you actually own it. But it's actually their house that you're living in, right? So they got to protect their interest. So you got to pay insurance, right? And of course you got to pay property taxes. So they don't expect you to pay mortgage insurance. I mean, not mortgage insurance, homeowners insurance up front, right? It's how it works. It's paid up front, and taxes paid in arrears, right? So there's going to be prepaids, meaning they're going to expect you to pay the first years of insurance up front, so that they know that your house is protected. So if you can afford that, you can afford to buy a house. That's the way they look at it, right? So homeowners insurance, of course, you got to pay mortgage insurance if you don't have 20% down, or if you're going to FHA. You got prepaid interest. What I mean by that, and it's kind of confusing, but normally you don't make a payment until the second first. And when I say the second first, let's say I moved on the 15th today, right? Well, I'm not going to make a mortgage payment on July 1st. That's the first. I'm going to be making my first payment in August 1st. That's the second first, right? But they still got to pay for interest. So there's still the 45 days, meaning 15 days of June and 30 days of July. Yeah, July. 45 days of interest I got to pay. So that's part of the prepaids, right? Because I'm not making a mortgage payment until August, but I still got to pay the interest for the days that I'm not making a mortgage payment, right? So that's why they call it prepaid interest. Property taxes and flood insurance, right? So there are a lot of things that you got to pay up front. Just be prepared for that. That's part of the down payment. That's part of the closing costs, okay? And they have you set up with an initial escrow payment, right? You have to have an escrow set up. So again, homeowners insurance. You see, look, there's a typo there. I didn't even notice that. There's this one without the apostrophe and this one without. I've taught this class for over almost a year, and a dozen times I never noticed that. So I gotta change that. There's like hundreds of versions of this. Mortgage insurance, property taxes, flood insurance, again, area specific. Okay. So when when I talk about how much money do I need to buy a house, this is not going to be enough, just so you know, right? 3%, 3.5%. Like people are like, yeah, I got 5% down. I'm good. No, you're not even close. And if you're thinking like that, if you're trying to squeak by, you're in for a surprise. Okay, you're gonna look at the loan estimate, and you're like, holy crap, I don't have this, right? So just be ready. Okay. General rule of thumb, and this is probably my favorite part of this answer is you need to at least have 10% down, at the most, or at the least, So if you have like a 3.5% down product or a 5% product or whatever, you're saving yourself about 2 to 5% for closing costs. Okay. And you also sometimes might need to have reserves. What is reserves? Well, it's money that we're not going to take from you, but it's money you have in the bank that you can show. For instance, let's say people have a 401k of $100,000, but they don't plan to use it because they're buying with 0% down. Maybe they're a veteran, maybe they're USDA, but they have $100,000 in their 401k. Well, the way we look at it is like they have $100,000 in reserves. Let's say the mortgage payment is $1,000, right? If the mortgage payment is $1,000 and they have $100,000, that means they have 100 mortgage payments in reserves. So that means that they could probably cover the mortgage for the next 5, 6, 7 years without a job, and they'll be fine. That's what we mean by reserves, right? So even though we're not requiring the money, it's good to have it in the system as part of your qualifying to show how strong you are, right? You might qualify better or easier if you have reserves. Okay. So a lot of people try to hide from me, like, ask them, how much do you have? Oh, I got enough. No, I want to know the number. I want to know the numbers so I can qualify you, right? I think they're afraid, like car salesmen. Like car salesmen will take advantage of. Oh, you got $10,000, you got $20,000. Well, it's gonna be $20,000 down payment, and therefore this you'll get. And they use that against the client to get the best deal, because I think you get a better rate if you put more down or something like that. So it would people would feel that they were taking advantage of when they told them how much they had cash, right? Whereas in the mortgage business, the down payment is going to be the down payment. Period. 3%, 5%, 3.5%, 20%, 10%. It's going to be that doesn't change, right? But knowing how much you have in reserves helps, and I'm not going to take that from you, right? So take that into consideration that you might want to volunteer as much as you can in terms of assets if you're wanting to have the best qualifying possible. Now, if you have millions of dollars everywhere, you don't want to tell us, but you have enough, like just in your local bank account, then don't tell us about that. That's fine. It all depends on the situation. Okay. All right. So we're at number 7. It looks like we are running along. Still, it's been an hour. Well, actually, I started late. So really, we've only been on for 40 minutes. Does anyone have any questions before I move on? Because I think the next 3, 4 questions are probably the most interesting for me. And I would think most interesting for most people. Okay, moving along. All right. What loan programs are available? Now, this is one of those questions where you probably have an unlimited or infinite amount of answers because it depends on which lender you talk to, which investors you talk to. I'm going to cover what I would think is the basic or typical loan products. Okay. So normal QM stands for qualified mortgage, and then there's non-QM, non-qualified. Okay. So when we're talking about QM, qualified mortgage, when we say qualified, we're talking about Fannie and Freddie, normal, right? Typical. Most lenders have it, right? You have conventional, you have FHA, USDA, and VA. Conventional, again, is like the typical vanilla, regular bread and butter loan that everyone's familiar with, right? FHA is a government insured loan, okay, which makes it more flexible, but also more strict. When I say flexible and strict, I know it sounds almost contradictory. They're more flexible in terms of like their credit score requirements and the amount of debt to income ratio they're willing to accept. They're more strict in that they have requirements like if you're in a community property state, you must add your spouse's debts. So in Texas, which is community property state, I would have to add myself and my wife to the loan. Even if I don't use my wife's credit and use her income, her debts are my debts. That's community property law. If I'm using FHA, they're going to require me to add my wife's debts. So if my wife has 0 debts, that's fine. But if she has all the debts and I have no debts, then I'm actually hurting myself by adding my wife to the loan because I'm not using her income or credit. Now, if I'm using conventional, I don't have to talk about the wife because it's not a government loan, right? So that's what I mean by strict and flexible, right? USDA is a government, is rural development, is government issue, so same thing, right? You've got to consider the legal parties of your family. Also, they consider not just your wife's income, but they also consider like your children's income or other people living there. If they're old enough, they're making money. You have to add that to the mix because there's an income requirement. That means if you make too much money, they're not going to allow it, right? USDA is a little bit more strict when it comes to credit scores and income. VA, I would say, is the most strict because you have to serve in the military in order to get that loan, right? And I have plenty classes about that. But let's just put it this way: if you're not a veteran, you're not married to a veteran, you don't know a veteran, you don't have to think about the VA loan. If you are, then we can talk, right? And next week I'm going to go deep on VA loans in general. So that's probably the most strict, like I said. All right, non-QM, non-qualified mortgages. These are mortgages that are created by investors that don't get traded or employ Fannie and Freddie guidelines or Fannie and Freddie. They're just not connected to the Fannie and Freddie in general, right? So a lot of them are portfolio loans. When I say portfolio, that means the investor is holding the loan. They're not, because if you don't know anything about mortgages, there's a strong chance that the lender that is doing your loan is going to end up selling it off to someone else to service the loan. So let's say I'm the lender, I'm Larry the mortgage guy with Open Mortgage. I do the loan for you. 2 months later, after we close, it might be now Chase servicing your loan, no longer Open Mortgage, right? So that's a Fannie and Freddie situation, right? When it comes to an investor in a portfolio, if it's ABC Mortgage Incorporated doing your loan, you might be making your payments to ABC Incorporated, or maybe an entity that they're connected with or they own that's doing the servicing. Okay. So that's kind of it won't be sold off in the secondary market. Okay. So what are non-QM loans? Well, you have jumbo loans, meaning they don't qualify or they don't fit in the requirements or the max county loan limit. That's a QM thing, right? They have a county loan limit all over the country on what's the maximum they're willing to loan to make it a qualified mortgage. Well, a jumbo loan means it goes beyond that, right? Bank statement loans, basically, instead of using regular income documents like pay stubs and tax returns and W-2s, they're qualifying you based on your bank statement loans, usually something that a self-employed business owner would use, right? They're qualifying based on what they're generating and what they're depositing in their bank statements, not what is on their tax returns or pay stubs or whatever, right? Investor cash flow loans, that is a loan where you are qualifying based on how much rent you're getting from a property, usually reserved for investors because you are required to have a primary already. So you can't buy this as a primary. This has to be an investment. You can buy as an LLC if you want, but basically you're choosing a property and the mortgage payment is the same or less than what you believe the rent will be. So let's say you are buying this property and the mortgage payment is 750 and you believe you can rent it for 1,000 and the appraiser agrees, then you qualify for an investor cash flow loan because the rent is paying for the mortgage. Okay. 1099 loans, that's a very specific exotic loan that uses only your 1099s to qualify you instead of like your pay stubs or tax returns. Construction loans, of course, is basically building a house and then you got to pay for the house. So it's almost like two different loans. One loan is to cover the construction and the build of the home, which involves contractors. And then one loan, part of the loan is designed for you to actually buy the house like a normal house. And they sometimes use it as a one-time close transaction, meaning you're paying or you're financing both at the same time. You're closing both at the same. You're signing paperwork for both the finance of the build and, of course, the actual purchase of the home, right? And then I-10 loans. I forgot what I-10 said for ITIN, something number, right? But basically, it's a loan for people who don't have a social security number. More than likely, they are not a U.S. citizen or they weren't born here, but they work here, and we can use that information from their I-10 number to qualify them. So I've actually been working with a couple of I-10 borrowers right now. So that's a non-QM mortgage product. Okay, but again, I put best to check with your local lender. about what loan programs are available, but those are the ones that I've run into, those are ones I've heard of, and ones where I believe it's not odd to ask a lender, do you do construction loans? Do you do I-10 loans? Do you do jumbo loans? I don't think that's an odd question. Okay. Now, if you're asking for like no interest loans or no document loans, that's something that most lenders are gonna be like, what? No, I don't think so. Yeah, it's there, but most lenders are gonna shake their head no. Okay. All right. How do I get 0% down? USDA is rural development. They want people to move into like these non-developed areas, and they want to pay you, or not pay you, but they want to not charge you 0%, not charge you a down payment, right? It must be a rural area. There's income limits, meaning you depends on how much you make. If you make too much, they won't qualify you, and they consider every single person living at home, like I said before. Okay. For VAs, veterans, again, I told you, if you are not a veteran, if you didn't serve in the military, if you're not related to someone, like you're not married to a veteran, then this doesn't apply to you. But if you do, there's technically no credit score minimum for the VA. It requires a certificate of eligibility, or COE. It's a document that the VA provides, and widows of veterans can qualify. Meaning, if you were married to someone serving, and we call it a veteran, but maybe it's just someone who died in active duty, during active duty, or they have an active duty related death, then you can qualify as a widow, right? So there's lots of ways to qualify for the VA loan if you're somehow associated with the VA. Okay. Now, for people who are not buying in rural areas or people who are not veterans, there's down payment assistance programs, there's grants and forgivable loans, there's soft second mortgage, silent second mortgages. A lot of these are I'm not familiar with, but they're out there. Okay. Piggyback loans, there's local programs, state or county. They're usually income specific or income limits, which is area specific. I've actually lost a deal because of the area a person chose, and I made the mistake of not double checking. Right. So it is very important. Again, I'll never make that mistake again. But yeah, make sure that the area that you pick, look at their income limits and see if it still qualifies them. There's credit score limits, usually 640, but I actually have seen where they can qualify up as low as 600, right? It requires extra time for processing underwriting because you're involving other parties, right? And there's national programs that has many similarities to local programs. I can do nationally, right? So I can do any state with down payment assistance. So if you have a borrower that needs down payment assistance and it's in the state that I'm licensed in or state that my branch is licensed in, I might be able to help with the down payment assistance. Okay. But again, it's best to check with your local lender. All right. What is the best interest rate? Now, to me, and I taught an entire class on this on Zoom and YouTube. You can probably search for it. I'll actually put a link somewhere maybe. To me, this is the stupidest question you can ask. Okay. And let me kind of give you the reason why. If you really think about it, why is someone asking what is the interest rate? It's because they just want to know if they should move forward, right? They want to know if you're the best in terms of price, whatever, right? The reason why I think it's a bad question to ask is because everyone's going to lie to you, right? Like if you haven't given your name to them, if you haven't given an application to them, and you're asking them what's the best interest rate, they're going to give you the most unreasonable, unlikely number possible that's legal because they want to sell you, right? You're asking a salesperson to sell themselves, right? So, hey, Mr. Lender, who gets no commission whatsoever when I buy a house using you, what's the interest rate? They're going to look at the interest rate sheet and they're like, okay, well, the interest rates are actually in the sixes, but you can possibly get a 4.5. It's about 4.5, right? Why? Because they want to give their best foot forward. They're selling themselves and they want you to apply with them. And to them, it doesn't matter if they lie to you or not because they can literally tell you whenever they pull your credit, oh, well, Mr. Customer, I told you a 4.5, but that's with perfect credit with 100% down and this and this and that. But your credit's not perfect. So you're actually a 6.5. And that's their defense. That's their shield, right? They got you to apply because that's ultimately what they want is your application, right? So they're going to tell you whatever they want. That's legal to get you to apply, right? So, like I said, the most likely scenario is the quote is inaccurate. Sometimes they purposely quote it lower with a fine print. Rates change daily. That's another reason why it's a stupid question to ask. They change daily, and sometimes multiple times a day. For marketing purposes, they're going to give you the best rate advertised, and it's comparable to a moving train. It's never the same. And missed quotes are not liable since they can blame the market, right? And they possibly add a discount price to look lower, but they didn't tell you because it's all over the phone. I can tell you whatever I want, right? So that's the danger of just asking people, Randy, what's their interest rate? What's the best interest rate? And I actually, again, in the class, I teach you how to get the actual interest rate without getting lied to, like one that you can actually depend on, one that you actually lock, right? I show you how to do that. But that's what's more likely going to happen. That's why I think it's a stupid question. Plus, you really shouldn't be looking at interest rate. You should be looking at APR, right? Annual percentage rate. So if you were to take anything away from this call, look that up. Look up the difference between APR and interest rate, and it will change your way of shopping for a mortgage. Okay, because that's really what the bottom line. Okay, but it's possible. Like I can possibly quote someone if they insist, because I get a lot of calls randomly. Because I guess a lot of people can find me on Google or Yelp, or whatever, or YouTube. So people ask me, "What's your best interest rate? What's interest rate?" I can quote them depending on uh, a certain situation. Like, what do you think their credit score is? How much are they trying to purchase? How much do you plan on putting down? What's your zip code? It's not reliable because people are trying to give the best case, but I can give you sort of, kind of a number, right? But how to get an accurate rate quote? Well, you got to apply, right? Like I said, you got to literally give me an application so I can pull your credit, everything like that, and get your documentation, and then you get under contract. See, again, I can give you a rate now when you're pre-approved, but it might be different the next month. And this is happening a lot. Like the rates are like crazy. Like, if you're watching this, after 6/15/2022, you might know that the rates like it went stupid crazy in the last couple of days, right? So you'll probably know that what I'm telling you is the truth right now. People who were qualified yesterday are no longer qualified because of the rates. People who were qualified last week are not qualified anymore because of the rates. People who were qualified last month for sure might not qualify because of the rates, right? So you can't get an accurate rate quote until you're under contract. Okay, so again, even if I'm giving you an honest number, I can't lock you, right? So because there's no property, so the number might change. The only time I can give you an accurate rate quote is if I can lock you on a property, right? But yeah, to get an accurate rate quote, you have to get under contract and you have to get a locked loan estimate. Okay. Without a loan estimate, again, it can change. I can give you a loan estimate with today's rates that's not locked, and you ask me for a rate quote the next day, and it might be totally different. It's happened a lot in this market. So the only way to get an accurate rate quote is to get a locked loan. That means lock the rate. What is it? Okay, let me lock it. Boom. That's your accurate quote right there. Okay. All right. I'm actually over time and I'm missing an appointment, but that's okay. It's with corporate. So I'll just reach out to them later. It's not a huge deal. I didn't think this call was going to be this long. But either way, I'm going to finish with this last question. How do I get the best interest rate? I'm going to read this and then I'm going to explain it. Okay. Choose your second favorite lender, apply to get pre approved, find a house, get a contract, send to a lender, request a rate quote, and lock it. Wait for the locked loan estimate. That means they're going to give you a loan estimate with a locked rate. This is after you're under contract. Okay. Do not sign it. Go to your favorite lender. So you're showing your second favorite lender now. After you get the locked loan estimate, go to your favorite lender and then send them. Right after you go through them, apply, get pre-approved, send the contract to the lender, and send the lock loan estimate from the second lender, your second favorite lender, that is the first lender that you talk to, but your second favorite lender, send them your lock loan estimate and ask them to beat it. If they can't beat it, ask them to match it. If they match it, well, you go with your favorite lender, obviously, right? But you can always float, meaning you can always like not lock to see if the rates improve, which it can, right? Rates are going up. Maybe by the time you're about to close, the rates will go down. And I think you should lock if the rates are the same or lower, okay, with your favorite lender. So I learned this in the car business, right? Like someone would come with me with a quote and they'd be like, you're my favorite car guy. This is my favorite dealership. So if you can beat this, then I will definitely go with you. And I'll look at it. I'm like, I can't beat it. I say, well, can you match it? And I'll ask my boss, and the boss matches it, they'll buy right away. And I'll make them commit to me. It's like, if I can match this right now, today, you will buy today. They're like, yes. So I go to my boss. I convince my boss, my desk manager, and when it comes to car sales, there's sales on both sides. There's sales on the client and the car salesperson, and there's sales on the salesperson and the desk manager, because you're basically asking the supplier to take a cut or whatever, and they have to see if it makes sense. So I'll be like, hey, Mr. Desk Manager, this client who's in my office right now says they will sign this right now if you're willing to accept this price. And they say yes, then I got a car deal, right? So they would actually bring a written quote from another dealership. Okay. So if they came in and they didn't have a quote, whatever, then and they asked me for the best price, I might give it to them just to give them a quote. But I might be like, well, why don't you tell me what your best quote is from someone else, and I'll see if I can match it or beat it, right? So that's how I developed this strategy. Okay. Special notes: once the rate is locked, you can't change the lock. It can only expire, and if it expires, you have to wait 30 days, right? So this is why you lock with your second favorite lender first. It's okay to tell your second favorite lender you're shopping. So basically, when you're applying with your second lender, you're saying I'm going to lock loan estimate. I do plan to shop this, right? It's okay to tell them that, right? You're being honest with them, and you encourage them to give you their best foot forward, right? Like, hey, just so you know, I plan to shop this, so give me your best, right? It's okay to do that. I think that they deserve the respect of transparency. Now, you don't have to if you want to, but I'm just saying it's okay if you want to do that. Okay. But again, I'm going to explain to you the process. You go to your second favorite. So you have two lenders, right? Okay. You go to two lenders. Lender number one, lender number two. Lender number one is your favorite, Larry, the mortgage guy, and lender number two is your second favorite, Gary, the mortgage guy, right? So you go to Gary, the mortgage guy first, because Larry's your favorite. You know, Gary, you apply, you get a pre-approval, you get a contract, you send it to Gary. Gary, what's my rate? Gary tells you the rate. Okay, lock it. Right. So Gary is setting you up to process your loan and sends you disclosures, a lock loan estimate, and he can't do anything until you sign it. Right. That's why I say, and that's why you don't sign it. Get the lock loan estimate. Go to Larry, your favorite lender, apply through him, and tell Larry, the mortgage guy, that you have a contract. And once Larry, the mortgage guy, gets everything together, say, okay, I need you to look at this loan estimate. Right. It's locked. Here it is. Can you beat it? Larry might look at it and be like, I can't beat it. Okay, can you match it? Larry might be like, I can match it. Okay, cool. Then I'm gonna go and go with you. So you get Larry to lock it, and therefore Larry is now your lender, and you got the best rate because you got the same rate as the lender number two, and he's your favorite lender. Of course, if he beats it, of course you lock right away. Now, if you talk to Larry and Larry can't beat it and Larry can't match it, then you float with Larry. That way, if the rates were to go down, hey, I saw the rates went down. Larry's like, yeah, you're right, and it's actually lower than your original loan estimate you sent me. So let's go, right? And you're like, yeah, go ahead and lock it. And now you're going back to Larry. It might delay some things, but it might be worth it to you to save on rate, right? So that's what I mean by how to get the best interest rate. Okay. Hopefully that helps. Hopefully that makes sense, right? All right. So bonus question, and it will be done. Do you need to do a hard inquiry in order to qualify me? The answer is yes. It's impossible for me to know where you stand without pulling your credit. Okay. And I actually put that, it's impossible to know your credit without an inquiry. Most credit report scores do not reflect accurately. I'm talking about like Vantage scores. I'm talking about Credit Karma. I'm talking about Experian, whatever the crap you see out there. Balances have effect on scores, so they might not know your balances. Disputes may inaccurately inflate your scores. Score is not the only thing that's considered. Okay, we also need to look at your debts. So DTI is determined by the monthly payments on reports. Certain remarks affect qualifications like recent rates. To manually determine liabilities is time consuming, meaning I'm not going to sit there and try to figure out what you actually owe, and you're not going to do that, right? And other details such as bankruptcies and foreclosures are considered. Okay. AUS, meaning the system I use to qualify you, reads the credit report. Without that, I can't do anything. Right? I can't. Let's put it this way. Let's reverse engineer it. In order to give you a pre-approval, I need to get an approved eligible on the AUS findings. AUS findings requires a credit report in order to read it, right? So there's nothing there if I don't pull your credit. So if there's no credit and I pull AUS is like missing a credit report. Nothing spits out. So yes, physically, in order to give you a pre-approval letter, I need a AUS findings of approved eligible, which requires a credit report, period. Okay. Freddie requires a hard inquiry. You cannot use other reports from online or the other lenders. Like you can't be like, hey, I got my credit pulled by this lender. Can I just give you the report? And no, that's not how it works. The credit report must be pulled into our system. Meaning like we must pull it. right? Number one, we don't know where that credit report came from. It might be doctor, it might be Photoshop, whatever. And number two, it's actually illegal for us to look at that credit report because it belongs to someone else. It doesn't belong to us. We have to put it in our own system. Okay. Again, human manipulation behavior element. Another lender's report pulled before major event. Maybe they pulled your credit, and I'm not saying you would do this, but maybe they pulled your credit before you bought a car, and then you went and bought a car, and you're saying, "Hey, why don't you qualify me based on this credit report?" And I'm like, I don't know what you did in the last week, right? You might have bought 5 cars. I don't know this. You see what I'm saying? You might be Dr. Forge, right? And only to make sure the system fair is to use unified reports, meaning we all use the same credit reports. Okay. And of course, according to CFPB, Consumer Financial Protection Bureau, it's there to protect you. So the most points you'll drop is 5 points. Usually, depending on credit, if you have great credit, you're probably not going to drop that many. If you have horrible credit, you're probably going to drop 5 points. And you can have unlimited credit pulls for 45 days. What I mean by that is if you went to lender A and had your credit report pulled on the 15th, you can have a credit report. You can have your credit pulled on the 16th by lender, 17th by lender, 18th by lender, twice on the 19th, 10 times on the 20th, and so on and so on and so on and so on until basically the last day of July, because it's 45 days, and it all counts as one inquiry. The CFPB designed it that way so that you can shop for the best lender and make sure that you're happy with who you're going with. Okay. They don't believe you're going to buy 100 houses. So if you have your credit pulled 100 times, they don't think you're buying 100 houses. They know you're shopping for the best lender, probably shopping for one house. Okay. Now, of course, if you apply for 100 credit cards, you're trying to do something crazy. You're trying to get 10 credit, 10. You're trying to get 100 lines of credit, right? So that's why they stop you, like dinging your credit, right? But they know you're not going to buy 100 houses, so therefore they don't count it against you. Okay. So again, you have unlimited credit pulls for 45 days. You can look it up, CFPB. Just put what happens when my credit is pulled and put CFPB, and you'll probably get an article from the CFPB talking about exactly what I just said. Okay. All right. So, we're done. So, any questions on that? This is the next class. So, if you are subscribed, like maybe through Zoom, then you will get invitations to this. But I'm not going to do it next week because again, I plan to put the VA loan classes and the first time home buyer classes together on the same time slot. So next week will be a VA related class, and then the week after that will be the first time home buyer class, which is where I will talk about this. Questions loan officers should be asking before taking an actual 1003. What I mean by that is what they should ask you before they actually pull your credit. Okay. So a little preview here as I go through this because I want to go to the end. But and then I talk about 5 things not to do when buying a home. Again, it's not what you think. Meaning, I have my version. There's probably a version you've seen online or you've gotten from your lender or you've read. It's not my version is different. Okay, so you can always later, or that'll be like 4 classes later, something like that. All right. So, any questions? Got a few people watching. A few people subscribed to the Zoom watching. All right. Well, you can always reach out to me later if you have any questions. Okay. Again, I really appreciate being on this call. Again, my name is Larry Lee. You can reach out to my cell number, text or call 832-606-2193 or email me at larrylee@openmortgage.com or put larrylee.com in your browser and search me. Or if you forget all this, you can always Google Larry the Mortgage Guy and more than likely you'll find me. In fact, I actually tried that out. I searched Larry Lee the Mortgage Guy and I did pop up. So you'll find me there. So again, if you have any questions, if you want to follow me, reach out to me, whatever, here's my information, right? Again, I really appreciate you guys being on this call, and I will see you guys next week. Remember, no first-time home buyer class is going to be about the VA, okay? And you'll probably get emails and notifications and whatnot. I'll try my best to inform you, all right? I really appreciate you guys watching. This is Larry, the Mortgage Guy, your mortgage insider and certified vetted mortgage advisor. See, right there. All right, later. I'm out. Thanks for watching, guys. See you later.